Oh, Warren.
Can everyone hear me? All right, cool. Let's get to it. Tomorrow, the market should be nice. So, got a little gap up after hours. Nice little futures gap up. I have like literally 20 SPY calls to swing. So, man, that should pay out pretty nice. I hope it stays. Apple, here, quick plays, right? Apple tomorrow, Walmart, Costco, AMD. Watch those. That's what I'm playing tomorrow. If you're not in the group, I don't know. All right, so I'm probably gonna go over like 3 different slides today, so it's gonna be a lot of information to take in. 2 or 3, I don't know. So first thing we're gonna look at, if you wanna learn how to trade, you have to be able to identify all these different candlesticks. Okay, these are when you're looking at a candlestick, right, there is a story behind each candlestick as to why they look like that, right? All these candlesticks look different. There's a reason why they look like that. Hammer, right, usually happens after a downtrend has a small real body. It occurs usually after a decline in price. This means that the sellers were driving the price lower and it was followed by a strong buying pressure to end the candle. So if I'm looking at a daily chart, this would mean that this is one day, right? If I'm looking at a 5-minute chart, then that would mean that this would be a 5-minute candle, 15-minute chart, 15-minute candle, and so on. Hammers look like this because it used to be a big red fat candle like this, okay? And then the buyers started to come in. Once the buyers came in, it forms this green candle, okay? That's why it looks like that. So when you find a hammer on the downtrend, you have to figure out whether it looks like it's gonna go back up. Now you can wait for confirmation. Obviously, you're gonna have these indicators to kind of tell you whether to buy into it or not. You don't just want to trade off of candles by itself. Now, candles doesn't always close green. Sometimes it closes red. Right? It depends. There's a lot of different variations of a hammer. Okay? Hanging man. Hanging man is just like a hammer on the upside after an uptrend, and usually it means that the it basically means that there is a lot of exhaustion at the top, because if this was to continue to go on an uptrend, what would happen is there should not be a lot of buying pressure coming in after an uptrend, because remember, right, this used to be a big red candle, right, that had a lot of people who ended up buying into it. But essentially, a hanging man is followed by a nice red candle. That's how you know if it's hanging man or not. Spinning tops. Spinning tops are always forming. Literally every single time you look at a chart, there's always going to be a spinning top somewhere. Okay, spinning tops are something that you should be aware of. Spinning tops conveys indecision, as both bulls and bears were not able to influence the markets. However, when you see the spinning top with respect to the trend in the chart, it'll give you a really powerful message based on which you can position your stance in the markets. Whenever I see an uptrend and then I see a spinning top, I want to see whether my indicators are telling me that there might be a potential reversal. Now, the next candle might confirm that, okay? An observation of how spinning tops work during a trend is the fact that there is an uptrend in the market, which implies the bulls have been in absolute control over the last few trading sessions slash candles. However, with the occurrence of the spinning tops, the situation is a bit tricky, since the bulls are no longer in control, because if they were, spinning tops will not be formed on the charts. With the formation of spinning tops, the bears have made an entry to the markets. Though not successful, the emphasis is on the fact that the bulls gave a leeway to bears, therefore leading to a more bearish attempt at the price. The color of the spinning top doesn't matter. What matters is the fact that the open and closed prices are very close to each other. Resistance, right? Resistance is something that stops the price from rising further, right? When we trade breakouts, we're trading when the price goes above the resistance level. That's a breakout, okay? If the price was to continue to go up this way, right, supported by volume or whatever, we would trade the breakout. In this case, right, what creates a resistance is 3 touches of either the wicks or the candles. Okay, that's my rule. I mean, that's like a general rule in the markets, for example. So the resistance level is a price point on the chart where traders expect maximum supply in terms of selling for the stock slash index. The resistance level is always above the current market price, right? The likelihood of the price rising up to the resistance level, consolidating, absorbing all the supply, and then declining is high. The resistance is one of the critical technical analysis tool which market participants look at in a rising market. The resistance often acts as a trigger to sell. Having learned about resistance, understanding the support level should be quite simple and intuitive. As the name suggests, the support is something that prevents the price from falling further. The support level is a price point on the chart. Can you guys like just save your questions for later? Like there's like literally everyone's just asking a question. Just if you are asking me a question before and then the answer is revealed in the next slide, right? Just wait. Or if someone asks a question, right? If you know the answer to it, just answer them. Okay. Or you can ask it. Someone else will answer it. Someone in the chat. There's people in the chat who actually know what they're doing. They're just here as a refresher. Okay. So if you do know what you're doing, please answer the people who are asking these questions in the chat. Someone just asked, when you're trading, do you watch the 1 minute, 5 minute, or 15 minute? It depends. That's my answer to you, right? It depends. There's a maximum likelihood that the price could fall to the support, consolidate, absorb all the demand, and then start to move upwards. Because remember, we're always talking about the reason why I'm always talking about supply and demand is because that's how the market operates, right? Supply and demand. If there's a lot of demand, the stock price will go up. If there is not a lot of demand, there's more supply than demand, then the price will go down. Okay, everything the stock market moves by people buying into stuff. Okay, that's how it moves. The support often acts as a trigger to buy. If the support breaks down, right, then that means it's a trigger to buy, to short the market, to short whatever stock you're looking at, right? Long-term support and resistances are useful for swing trading, okay? Long-term support and resistance. Can you guys give me an example of what time frame a long-term support and resistance can be? A long term, so it depends like this. So when you are on Thinkorswim, right, they give you an option to look at a 4-hour chart. Now the 4-hour chart, you can look to see if you want to look at a 20-day 4-hour chart or a 180-day 4-hour chart or a 200-day 4-hour chart. So when you have a time frame, when you're looking at a time frame, the number on the left side, if it's more than for example 100 days, or if it's more than 200 days, and that's long term, right? When you're looking at a 5-day 5-minute chart, that's not long term, that's something that's very recent, right? So short term support and resistance, that's useful for intradays and scalps. So support and resistance are points on the chart. Support is a point below the current market price that indicate buying interest. Resistance is a price point above the current market price that indicates selling interest. To identify support and resistance, place a horizontal line in such a way that it connects at least 3 price action zones, well spaced in time. The more number of price action zones the horizontal line connects, the stronger the support and resistance. So support and resistance can be used to identify targets for the trade. For a long trade, look for the immediate resistance level as a target. For a short trade, look for the immediate support level as target. Volume. I talk about volume a lot, right? Volume plays an integral role in technical analysis because it helps you confirm trends and patterns. Consider volumes as means to gain insights into how participants perceive the market. Volumes indicate how many shares are bought and sold over a given period of time. The more active the share, the higher would be its volume. You guys see how there's a hammer, there's a basically a hammer candle here, and then you see that the volume has spiked over here. You guys see that, right? And that was basically the beginning of the reversal for this specific chart that we're looking at, right? So the fact that there is so much more volume here, the fact that this volume bar is so much bigger than the past 2 days, right? And the past 2 days has been in an uptrend. And also, right? And also you have a lot of buying pressure coming in on this candle, right? Is that you guys see how this was the beginning of the reversal? Right? Because if this was to keep going down, then this should have been a red candle. But then you would already see that this candle has a lot of buying pressure coming in because of that long lower wick. And the fact that there was a lot of volume down here compared to the previous 2 days, it kind of gives you an idea. Oh man, why is the volume so high? Why is everyone trading this today? right? And then you see this candle forms, and then you're like, okay, this might be a potential reversal. So in this case, right, you can either enter on the next candle or maybe even the candle after. The reason why I say the candle after is if you look at this candle that my arrow's on, and then you look at this candle that my arrow's on, and you look at this candle with my arrow's on, if you make a horizontal line through that, what do you have? Right. You have that resistance level. Okay, so if I had a horizontal line through there, I might want to wait for the horizontal line to break, which is essentially this candle or this candle. I'd still make money on to the upside, right? Because this thing already took a hit. So there's different ways for you to trade it. You can trade it on this candle. That's up to you, but that's more risk that you have to add on to yourself, right? There's a lot of uncertainty going for it to go back up. Volumes are used to confirm a trend. The end of day volumes indicate the cumulative volume across trades executed throughout the day. High volumes indicates the presence of smart money. Low volumes indicate retail participation. When you initiate a trade to either go long or short, always make sure volumes confirmed. My my thing is this with volume. I want to make sure the volume bar is bigger than the past 3 or 4. That's just me with volume, right? If the volume is weak, it's low, then I don't see a reason why I should get in the trade. Obviously, I'm looking at other indicators too, but volume is one of the biggest things I look at. Avoid trading on low volume days. What's a low volume day in the market? A low volume day can be a day when Powell speaks, when the Fed speaks. Fridays can be low volume days. So this is what a rising trend line is, right? If you draw if you draw a trend line by connecting the swing lows are just the lows of the swing, right? This is what's called this movement to the upside is called a swing. Okay, when you're looking at swing lows, you're looking at the lowest points of that whole swing. You can create a trend line going all the way up, right? You wait for the trend line to break. A trend line break signals that the market is approaching the limits of its brief push against the trend. You can use a price pattern as a trigger for entry. What does it mean for a trend to resume, right? You can make different resistance levels on the chart, on whatever you're looking at, right? In this case, you have a lot of resistance over here and it couldn't break, right? This breakout, right? That's the type of trades that you kind of want to take, the breakouts of the resistance, okay? And then you can see that it creates another one and it breaks out again, right? So these types of things are not necessarily predictable, but when you see these things happen a lot, right, it's almost like it's common sense to trade them, okay? Trading breakouts is a common strategy. The usual approach for breakout trading is to place entry orders and stop orders at support and resistance levels. So let's say you're bullish here, right? It's not surprising that you're going to consider placing entering at the resistance, right? So if it goes up like this and it retests it again and then it's breaking out, right? That's usually when you would enter the trade, or you can wait for confirmation, right? This tactic will create a long position for you as the market surges up and proves your bullish hypotheses. Here, the market dashed up and triggered your buy stop order, but price action reversed down within the very same candlestick. This is why it's important to wait for confirmation as well as volume. You don't really have to wait for confirmation, right? That's my thing now. You don't have to wait for confirmation. You can enter as it's breaking out, but understand that if it does fake out on you, right, you want to exit, right? You want to exit if it goes below the resistance again, and then you just want to take the loss, right? There's really nothing you can do when things fake out on you. Here are some excellent examples of pin bar being used for long and short entries. These pin bars are defined by support and resistance. If you really pay attention to this next example, you have a resistance forming here, right? So you make this initial line, right? And then you have this support here, right? The reason why this is support is because we had we had a pretty big, a pretty decent dip going down this way, almost like a bull flag, right? Pretty decent dip. And then we had another, right? Another retest here and another retest here. Okay, now in this case, if you use this as a resistance, right, you would see that there's a lot of selling pressure here, right? In this case, for example, if I was looking at this on a 1 minute time frame or a 5 minute time frame, then this rejection would give me an entry to go to the downside because of this rejection here again. And I would enter this trade. If you pay attention to this, I would enter this trade below this right here where my arrow is. Because if I make, right, you guys see this arrow? If I was to make a horizontal line to the left, is it going to be a nice little support slash resistance level? I'm just wondering. Am I going to get at least 3 touches if I make a line to the left? Right? If I make a line to the left right here. So this is 1, right? 1, 2, 3, right? You have to watch out for these wicks. They will more than likely have the same, literally the same zone, right? The same zone level. Literally 1, 2, 3. This, if you have a line going through this way, you would see. How about if I go to the right? Do you think it's going to touch those wicks on the right? If I go to the right. So 1, oh shit. 1, 2, 3. Finding volume spikes is the easiest way to spot the big players. And even when you do spot the big players, profits are not guaranteed. They offer a fantastic first clue, right? They offer a fantastic first clue, but the demand and supply puzzle remains unsolved. You need to analyze other market clues to determine if a reversal trade is worth the risk or not. In this case, right, you have a nice downtrend going this way, and you have the breakout of the downtrend, right? You would assume that it's going to keep going up, right? Now, when you have a big downtrend like that, you have to kind of wait for the volume to kind of spike up at the breakout. Like in this case, if you were trading this breakout, obviously you would lose money holding through this, right? In this case, if you were to create and wait for a range to show up in this equation right here, right? If I make a box right here, that's a range, okay? And if you see a volume spike on the bottom um, after it's ranging, then that's when you essentially want to take advantage of that trade. Sometimes a lot of people, especially when it's like after a really big downtrend on a higher time frame, a lot of people are too quick to just enter for a reversal and setting contracts that are expiring that same week or next week. You got to give yourself some time because that stock has to accumulate its buyers first, right? It has to find its buyer and it has to find its balance first because you don't know who the big money is in that play, in that reversal play. The Dow theory. The Dow theory has always been a very integral part of technical analysis. The Dow theory was used extensively even before the Western world discovered candlesticks. In fact, even today, the Dow theory concepts are being used. In fact, traders blend the best practices from candlesticks and Dow theory. Indices discounts everything. The stock market indices discount everything which is known and unknown in the public domain. If a sudden and unexpected event occurs, the stock market indices quickly recalibrates itself to reflect the accurate value. Overall, there are 3 broad market trends: primary trend, secondary trend, and minor trends. How many of you have actually read about the Dow theory? Anyone? Okay. Just wondering. The primary trend. This is the major trend of the market that lasts from a year to several years. It indicates the broader multi-year direction of the market. While the long-term investor is interested in the primary trend, an active trader is interested in all trends. The primary trend could be a primary uptrend or a primary downtrend. The secondary trend. These are corrections to the primary trend. Think of this as a minor counter reaction to the larger movement in the market. Example, corrections in the bull market, rallies and recoveries in the bear market. The counter trend can last anywhere between a few weeks to several months. Now, minor trends. These are the daily fluctuations in the market. Some traders prefer to call them market noise. So when we're trading during the day, are we looking at minor trends, secondary trends, or primary trends? We're just looking at minor plays, right? We're just looking at minor. When you're trading, when you're looking at the one day, one single day, it's just minor. It's a lot of daily fluctuations, right? If you look at the bigger picture and you pull up a weekly or a monthly chart, you would see that the daily that has nothing, it will not affect it at all. Volumes must confirm. The volumes must confirm along with price. The trend should be supported by volume. In an uptrend, the volume must increase as the price rises and should reduce as the price falls. In a downtrend, volume must increase when the price falls and decrease when the price rises. Between the open, high, and close prices, the close is the most important price level as it represents the final evaluation of the stock during the day. The Dow theory suggests that the markets are made up of three distinct phases, which are self-repeating. These are called the accumulation phase, the markup phase, and the distribution phase. The accumulation phase usually occurs right after a steep sell-off in the market. The steep sell-off in the markets would have frustrated many market participants, losing hope of any sort of uptrend in prices. The stock prices would have plummeted to rock bottom valuations. Can anybody remember when the last time we had rock bottom valuations? Yeah, recently, right? Recently too. You guys have to understand. Just because we didn't go back to the prices that we were in 2008, 2007, you have to understand we were already in a nice little bull run. We had such a bigger dip than we did in 2008, and from the coronavirus, we had a really big dip. The distance between the top to where the bottom of the dip was bigger than what happened in 2008, 2009, whatever. You guys know that we wiped out five whole years of gains, right? Everyone who bought into their fucking 401ks in 2015 or 2014 they were fucked. Do you think that they knew to hold their positions? Some of them probably panicked on the way down, to be honest. Not even just 401ks, to be honest. Like people like normal people, right? Moms and pops who are always showing off their portfolio. I have Apple and I have this. So those types of people, they were all like, I was just looking at this huge dip, and I was like, wow, so many people lost money. Like, so many people lost money. Do you guys know that the feds own the most stock now because of all the pump? And it's a fact. Go look it up. If you guys don't believe me, look it up right now. it is yeah. There's a lot of like fucking a lot of like discrepancies between it, but they I don't know. Just read over it. Just read over it. I read this today and I was like, no way. I was like, no way. But anyways, right? That's beyond our control. Like honestly, that kind of thing is beyond our control. Like you can't. Oh, where did I get it? Go on Twitter and look up Zero Hedge. Follow this account. They got banned. They got banned like fucking four times off of Twitter, and then they they kept making accounts. Anyways, they have a lot of they have their own blog, so I always read up on that every day on what they say. Smart money is usually the institutional investors who invest from a long-term perspective. They invariably seek value investments, which is available after a steep sell-off. Institutional investors start to acquire shares regularly in large quantities over an extended period of time. This is what makes up an accumulation phase. This also means that the sellers who are trying to sell during the accumulation phase will easily find buyers, and therefore the prices do not decline further. Hence, invariably, the accumulation phase marks the bottom of the markets. More often than not, this is how the support levels are created. Accumulation phase can last up to several months. Did we even have an accumulation phase after the big drop? Or did we just have like a whole fucking V? You know what was crazy too, guys? Like, man, like I was looking at that reversal and I was like, there's no way. Like there's no way this thing is gonna reverse this hard. Right? I was so mad that I didn't get in at the earliest. Of obviously we rode the stocks up, but what do you think we were doing as we were riding up? Were we swinging it? No, we were not swinging it. We were just most of the time we were day trading these moves and we were catching them. But if we had known that it was gonna keep, if we had known that it was gonna keep going up for months, like dude, like a swing trade would have been phenomenal. Hindsight does hurt. At least we caught moves up, right? That's the thing that you have to kind of remember. When you see big moves happen, when you see big moves that have happened, you can't really blame yourself because you never would have known, right? You never would have known. I never would have known, right? No one would have known other than the ones who create the market. But you never, I never like for example, I'm gonna talk about something else real quick. When I miss moves, when I miss a move, I don't beat myself up anymore. I used to. I used to be so mad when I would miss like a $50 move on Amazon or $100 move on Tesla. I'm always like, oh my gosh, dude, I could have caught this and I could have, my if I had $1,000, I could have turned it into 10 with this move, right? It's always you're always thinking about, oh man, if. Now understand this, right? I mean, I've been in the market for like what almost 3 years now. Every single fucking year, there's at least a dozen moves, a dozen big moves. Right? I'm pretty sure everyone here who's been in the markets for a while can agree with me. There are always going to be these huge moves. Now, what is the most important thing for you to do? There's two words. No, no, no. What do you have to, what are you doing every single day? You wake up, you what? Show up. You just have to show up. That's one thing that I tell people like, okay, hey, you don't have to trade today, just show up, right? Watch the movements, right? Show up. And the fact if you show up and you are disciplining yourself and you're waiting for entries to come to you instead of you looking for these trades, then you're creating a habit, right? It's all about habits. Once the institutional investors, aka the smart money, absorb all the available stocks, short-term traders sense the occurrence of a support. This usually coincides with improved business sentiment. These factors tend to take the stock price higher. This is called the markup phase. During the markup phase, the stock price rallies quickly and sharply. The most important feature of the markup phase is the speed. Because the rally is quick, the public at large is left out of the rally. New investors are mesmerized by the return, and everyone from the analysts to the public see higher levels ahead. Give me a second. I want to go to the next one. Technical analysis. Again. Overview, right? Technical analysis is a tool or method used to predict the probable future price movements of a security, such as a stock or a currency pair, based on market data, right? You can literally have technical analysis on everything, right? I can make technical, like, for example, I can make technical analysis on the real estate market, on Forex, right? As long as it has a history, as long as you're trying to predict how much it's going to move in the future, you can do technical analysis. The theory behind the validity of technical analysis is the notion that the collective actions, buying and selling, of all participants in the market accurately reflect all relevant information pertaining to a traded security, and therefore continually assign a fair market value to the security. Technical analysis allows us to believe that current or past price action in the market is the most reliable indicator of future price action. Technical analysis is not only used by technical traders. Many fundamental traders use fundamental analysis to determine whether to buy into a market, but having made that decision, then use technical analysis to pinpoint good, low-risk buy entry price levels. Technical analysis continued, a type of past price analysis which uses mathematical models and calculations to predict future price movements. Supply and demand, right? Always supply and demand. It always boils down to supply and demand. Supply and demand is driven by many factors, including fear, greed, financial incentive, herd instincts. Herd instincts, has anyone even ever heard of herd instincts, right? I'm going to go over psychology next week, but psychology is the most important thing. Like, you have to understand crowd behavior. Like, I read up on psychology a lot too. Like, you guys are going to notice, if you've been trading for a while, that it's not everything is about strategies, charts, technical analysis. Like, it's really bigger than that, right? Because let me tell you, like, I can give you 1,000 strategies, but you can still fail. Why? Tell me why I can give you guys 1,000 different strategies, but you will still fail. Some of you will still fail. Can someone tell me why? Does it have anything to do with the chart? No. It's all mental. Like, this whole thing is you're gonna understand that it's all mental, right? Of course, you have to know all this technical analysis. You have to know how the market works, blah blah blah. But honestly, at the end of the day, you are going to understand that it's a game that you're playing, and it's a lot of psychological aspects to it. Because let me tell you, like, there's been so many occasions where I sell my position, and next thing you know, the price just shoots back up right after I sell it. And then that's something like, it's like, what the fuck? Like, how does it happen? How did it happen so fast to where I literally just sold my position and then the stock price goes back up? Has that ever happened to anyone? It's like, what the hell? Like, it almost feels like the market's going against you, right? Like it almost feels like the market has something against you. Okay? Now you have to understand that this game that you're playing, right? It's like a lot of you versus you, right? It's crazy, because you sometimes you feel like the intimacy of it, like the market is just the market is just against you, right? But here's the thing, right? But then if you look at it this way, how many times have you traded and you were up for the day and you could have walked away, but you didn't? right? You guys have no excuse. I have an excuse. You know why? I have a trading group and people want me to give them call outs and signals. I can't just walk away. I have to look at it. And that's something that I struggle with because shit, like I'll be up like 6,000 for the morning. And then people are like, hey, are there any more signals? And I'm like, dude, oh man. I go back. Guess what happens? Guess what happens when I sit down again? I overtrade because I'm over here signaling stuff because I would feel like shit if I don't enter the signals I put. And then next thing you know, I lose money because I'm over here like shit. You know what I mean? So understand that if you are do not have, right? Don't have a money goal for the day. Don't be like, I want to make 200 today. No, don't fucking be like that. Right? You want to focus on being able to execute your trade and having a good trading day. You can have a good trading day, but be down for the day. Can someone who agrees with me? You can have a good trading day, but still lose money. Why? Because sometimes the strategies aren't working and it's out of your control. At least you executed on your plan and you exited your position when you were supposed to. That's still a good day. Right. And I know a lot of people say that's true, that's true, that's true. But in reality, when you're in that situation, you're like, fuck, I'm down money. And then what happens is you want to go back to the market to chase that loss that you just took, not even registering the fact that you just took a loss and like, let's say it's already like midday and then you are completely oblivious to the fact that it's midday and it's low volume. All your focus is on just tracing that loss you just made. There's been so many fucking times when that happened to me. These factors create repeatable patterns which we can recognize and profit from. Technical analysis encompasses a wide range of charting techniques used to try and predict the move of a certain market. Technical analysis includes the use of time cycles, trend lines, candlestick formations, moving averages, chart patterns, and all the other indicators. Time frames. The time frame a trader selects to study is typically determined by that individual trader's personal trading style. Intraday traders. Traders who open and close trading positions within a single trading day favor analyzing price movement on shorter time frame charts such as the 5-minute or 15-minute charts. Long-term traders who hold market positions overnight and for long periods of time are more inclined to analyze markets using hourly, 4-hour, daily, or even weekly charts. If during market hours, the 4-hour chart shows a potential bullish run, is this an indication for a day trader or swing? If during market hours, the 5-minute chart shows a potential bullish run, is this an indication for a day trader or swing? Did we go over this yesterday? No, right? All right. Why I'm starting to feel like it's like we went over this yesterday. Hold on. Oh, I didn't show this though, right? Okay. Strategy number 1: EMA crossovers plus the stochastic crossovers. I'm gonna go over what stochastics are on my next slide, but to tell you, With the stochastics, this is what it looks like on the bottom. Red line and purple line. Can anyone tell me what the stochastics actually allows you to kind of measure? Momentum. The stochastics oscillator is a measure of momentum. Okay. I like to look for shifts in momentum, right? A shift in momentum is when it crosses over, especially if it crosses over from the downside to the upside. That's what a shift in momentum to me is. Now, what can anyone tell me? This is the strategy, right? 9 EMA cross above the 21, and then you want to look for the stochastics to cross. But what if I was to, what else do you guys see here that happened in the chart other than the stochastics and the EMA? Yeah, a little increase in volume, right? Just know the price kept going up after this. It went all the way up to like fucking. I remember this example. It went all the way up to like here. So, if you were to give me a step by step on what to look for in this certain strategy, what would it be? What's step number one? What do you look for? You want to wait for the stochastics to cross first, right? For everyone who doesn't know, you wait for the stochastics to cross first, and then you wait for the crossover to happen. As the crossover is happening, what will usually happen is the volume will be spiking at that time, right? The volume doesn't have to be this big, first of all. What does the volume have to be? Does anyone know the answer to this? What does the volume have to just be like? It just has to be bigger than the previous 4 or 3, right? When you're looking at crossovers, right, you have the 9 and 21. Now you can use the 4 and the 8 and the 50, the 15 and the 24. I just like 9 and 21. Now, the reason why I use the crossovers is you have to wait for the lower EMA to cross above the higher EMA. So in this case, if you're using a 4 and 8, you want to wait for the 4 EMA to cross the 8, right? You can use 1020, doesn't matter, right? If you're looking at a 5-minute chart and you have a 9 EMA, how many minutes is the EMA taking an average of? 45 minutes, right? If I'm looking at a 21 EMA and I'm looking at a 4-hour chart, right? How many hours is the EMA taking an average of? Around 200 hours, right? When the lower EMA crosses above the higher EMA, it generally means that it's a buy signal. Watch for the stochastics to cross and then watch the EMAs to cross / vice versa, right? Just like in this example too, right? Same thing. In this case, we had a crossover right before the open, and we had, if you see the top of this wick right here, right, is that a resistance level or not? You had who agrees with me that there was literally 2 resistance levels in pre-market? You have one here and you have one here. I just didn't make the line for this example, but you have 2, right? Now you have the shift in momentum happening. Obviously, in the morning, it's going to have a lot of volume, so you don't even have to worry about opening volume. You just have to have the crossover as it happens, right? This is an hourly chart, right? When you have this type of setup showing up for you, this usually allows you to be more comfortable holding the trade for how long? No, not swing, not even swing, guys, not swing. Holding the trade for the whole potential move. Does that make sense? You know how people are always like, oh, when should I take profit, this and that. But when you have this type of crossover where the momentum is so strong, it doesn't, you can essentially try to capture the whole move without even being, without having anxiety. Like, how many of you get fucking anxiety? Like, I get anxiety holding shit through, like, after like 60-70% sometimes. I'm like, oh my gosh, come on. I'm like, come on, go. I'm literally getting ready to like hit the sell button. But literally, especially if I'm like 7K in, like if I'm up like 7,000, 8,000, 10,000, I'm just like, oh my gosh, oh my gosh, oh my gosh. You know what I mean? Trust me, that's me on the inside. Like you might, like, you'll see me in the group all calm and shit, but deep inside, I'm having like a fucking mini heart attack, right? I'm like, oh my gosh, keep going. I need this. I need this, right? So come on. Obviously, I'm not like greedy about it. Like, I'm not like, oh my, I want more, but it's just, it gives me that anxiety. I'm like, dude, like, come on. Especially if I know that it can keep going up, right? Especially if I know, like, if the ATR of Amazon is $100, right? And then I wrote a $70 move, right? And I know it can potentially move another $10, right? So it's like, oh my gosh, I just need that extra $10, right? A whole move. Someone asked, what's a whole move? What do you mean whole move? Whole move is when you get into a trade and you wait, you hold on to a trade to its average ATR. Does that make sense? If the average trading range on that stock is $10 and you get in after $2, then there might be an $8 move left of that stock to move. ATR is its average trading range. Every single stock that you look at has an average trading range that it trades. Sometimes Roku's average trading range can be $10. Apple can be $12. I don't know about Apple now because that shit's at 100 something dollars. So maybe that ATR, obviously Tesla's ATR is no longer $100. Remember that, guys, right? That thing is at like $430 now. Can someone tell me? Wait, can someone actually tell me what Tesla is at? I remember Elon Musk saying he wants to take Tesla private at 420. Imagine. No one else can buy shares. Because remember, he literally told everyone that there was gonna be a stock split. You guys don't remember that tweet that he made? No one knew though. Like, no one was able to decode the encryption. It was crazy. It was so crazy. He probably waited for the right time. He was like, damn, that was insane. That was a good one. He said, can anyone does anyone remember what he tweeted? He tweeted this. He tweeted that there's going to be a stock split, except you didn't know that. He said he tweeted the price was too high, but literally it was on May 1st at 8:31 a.m. So a 5-to-1 stock split at on August 31st. No one would have known that. No one would have known that. For every trading strategy, you must find the right stocks to trade, along with the right entry, exit points, and risk management rules. Bad risk management can make a potentially profitable strategy unprofitable. Learning to trade profitably isn't easy. Like any other careers or profession, you have to pay your dues and put in the effort. Losses will come and go. That's a fact. You just have to minimize your losses, win bigger and lose less. If you have a trading strategy that works 20% of the time, right, you can still be profitable, if that makes sense, right? As long as you limit your losses, right? Bollinger Bands. Bollinger Bands are used to measure a market's volatility. One thing you should know about Bollinger Bands is that price tends to return to the middle of the bands. So anyone here use Bollinger Bands at all? If you haven't used this, you want to kind of try it out to see how it works for you. What I like to look at for Bollinger Bands is, for example, when it's too overextended, right? Especially when you have like an EMA with there along there, you have a stochastics along there. It usually tends to retrace down to the middle, right? Bollinger squeezes. The Bollinger squeeze is pretty self-explanatory. when the bands squeeze together, you guys see how it's getting really tight? That means it's awaiting a breakout. It usually means that a breakout is getting ready to happen. If the candles start to break out above the top band, then the move will usually continue to go up. If the candles start to break out below the bottom band, then the price will usually continue to go down. This is different than a potential reversal down to the mid band, because we're talking about when these bands start to squeeze, right? Not when they're overextended. So there's two different ways to trade these bands. There's so many different ways to trade these bands. This and the other one that I just showed you is just two different ways to trade it. After the bands have released into the bigger band, that's when we look for reversals. Like this, you see the squeeze right here, right? You have a big band squeezing into the middle here, and you trade the breakout, whichever candle sticks up or down, right? If it sticks down, then you trade the break, you buy puts. Bollinger Bands plus stochastic strategy. You can see here that the bands were squeezing pre-market, right? And the stochastics cross plus the initial hourly candle you see pierces through the top band, causing the price to move up and the bands expand. Does this chart look familiar to you? Does this chart look familiar to anyone? Did I not just show you guys this chart with a different strategy, with the EMA crossover? There are a lot of different ways for you to trade, guys. This is what I'm showing you. This is the point. There's different ways, there's different strategies you can take advantage of. Like I said earlier, remember, it's not about the strategy, it's about you. Remember that. I can show you fucking RSI and MACD and it'll show you the same fucking thing. You can have buy signals with every single strategy out there. It's a strategy for a reason. If it worked for someone, it'll work for someone else. People post strategies because it works for them. People are so worried about which strategy they choose, this and that, but they fail to realize that that's not the most important thing. And then you're gonna find out for yourself anyways. You're gonna see, if you're new, especially, you're gonna see that. You're gonna run through different strategies. You're gonna find one. You're gonna find the one for you. But you're gonna realize that it's not all about the strategy. It's all about what's going on inside of your head when you're trading. Bollinger Bands plus stochastic strategy using daily charts. You see how the stochastics crosses over down here, and then the price does what? Drops. Why does it drop? Because there was a shift in momentum. Boom, right? Same thing up here. This is a good signal. Oh, what? Because this was on an uptrend. What candle is this that we're looking at up here that we just went over earlier? Hanging man. And then what candle is this one down here? Hammer. When you have a hammer on there, and then you have the bands that just expanded, that's overextending out of the band, can potentially retrace. You have decent enough volume, plus you have the stochastics crossing over from it being bearish and it shifting to a bullish momentum. Don't you have 4 different indicators telling you to enter the trade? At this point, it's up to you whether you want to execute, right? Right? When you have all these buy signals, it's up to your execution now. Stochastics, I know that it looks tempting to just use stochastics by itself because look, literally, crossing down, price moves down. Crossing up, price moves up. Crossing down, price moves down. Crossing up, price moves up. Crossing down, price moves down a little bit. Crossing up, price moves up. This is a daily chart. But I'm telling you guys, Don't just go by the stochastics. You guys see how easy it looks to trade the stochastics? Literally. Like, oh my gosh, crossing down, price goes down. Crossing up, price goes up. Crossing down, price goes down. How do you avoid false breakouts on that big red candle? How do you avoid false breakouts? You can't. I don't get why people are always trying to avoid fake outs. It's not that big of a deal. It's not that big of a deal if you're consistent. You can't avoid it. Like, for example, if you get into a trade and next thing you know, Trump tweets something bad and the stock market goes down, how do you avoid that? What are you gonna call Trump and say, man, can you say something good, please? Can you please make the price go up because I'm down? You can't avoid it. Like, what are you gonna do? Call the White House? Bollinger Squeeze plus the 9 to 21 EMA strategy, right? So this is not even using the stochastics, right? You have the squeeze happening here, right? And then as it expands, you have a crossover here. Along with the crossover, what kind of candles do you have here? These are rejection candles. Why are they rejection candles? Because they have a long upper what? Wick. They have a long upper wick. Stochastics. The stochastics oscillator is another technical indicator that helps traders determine where a trend might be ending, right? Oh, what was the previous slide that I had? Oh, never mind. The oscillator works on the following theory. During an uptrend, prices, wow, so much. Thank you, Chuck. Thank you. Just trying to help you guys out, all right? Like, it's not that serious when it comes to showing strategies. At the end of the day, like I said, it's not about the strategy. It's how well you execute on your trade. Because like I said, I can tell you so many different strategies, but if you can't even manage your own trade, you can't manage your own risk, then you're going to fail. You're going to fucking fail. Like, honestly, everything that I tell you is on the internet. You can find this on the internet right now. You guys got to look it up. You guys have to take the time to look it up, right? The stochastics oscillator is another technical indicator that helps traders determine where a trend might be ending. The oscillator works on the following theory. During an uptrend, prices will remain equal to or above the previous closing price. During a downtrend, prices will likely remain equal to or below the previous closing price. The stochastics oscillator uses a scale to measure the degree of change between prices and from one closing period to predict the continuation of the current direction trend. The two lines that cross are similar to the MACD lines in the sense that one line is faster than the other. Can someone tell me which one's faster, the purple or the red? The red. Okay, the red. That's how the stochastics basically kind of looks like. And whoever is asking me what chips I'm eating, it's Ruffles. The cheese one, okay? The cheese one. I only like the cheese one. Stochastics continued. You can use the stochastics oscillator to measure the speed and momentum of a price over a time period. A low value points to the strong uptrend as much as it points to a strong downtrend. A high value points to the strong downtrend as much as it points to a strong uptrend. Does that make sense? Number 2 and 3? Like, you have to understand, a low value point to the strong, a low value points to the strong uptrend as much as it points to a strong downtrend. Let me go back. A low point, right, points to a strong downtrend as much as a strong uptrend. So if the stochastics is down here, it usually means that it's a strong downtrend, okay? If it keeps going like this, right? Now, when it starts pointing up, when it starts to point up like that, right? That's when it can point, that's when the momentum can shift to the upside. Stochastics oscillator works best when used with leading indicators, chart patterns, and volume and price movements. The trend following strategy can be a profitable one to use with stochastics. Stochastics oscillators must be paired with multi-frame analysis. What is an example of a multi-frame analysis? Simple, right? Looking at different time frames when you're trading. You don't want to stick to the 1 minute. I hate people like that sometimes. They're just looking at the 1 minute the whole time. I'm like, bro, can you just like extend it out a little bit? Go to the 15 minute or something. Go to the fucking 5 minute or something. You have to be able to look at multiple different time frames. Like me, like for example, like you can do this too. Like me, when I'm day trading, I go on the 5 minute. Like I'll have the 5 minute on, I'll have the 15 minute on, and then I'll have a 30 minute on. That's it. I'll have the 1 minute if I'm ready to scalp, if I'm gonna scalp. My favorite time frame for swinging, honestly, is the 4 hour. It's like the best thing for me. Like I'm so used to it. Also, you're gonna get used to your time frames that you're looking at, right? I'm used to the 4 hours. Like I'm not very comfortable using the 15 minute, but I'm so used to the 4 hours because I'm always looking at it. So it depends where you're used to. You're gonna get used to a time frame that you like. For my daily support and resistance. Oh, let me just do this real quick then. Let me show you guys how. Do you guys want me to show you how I make my support and resistance real quick? I'm not gonna take that long. I have to log in first. In the meantime, you can go to the bathroom, go pee or something. I know some of you are probably like holding your pee in the seat. I don't want to leave the seat. I don't want to miss anything. Damn, chill. If the stochastics bounces and doesn't cross, it depends. It depends on the situation. All right, look, I'm gonna show you guys right now. All right, you guys ready? Right here, my friend. Can you guys see the? Can you guys see my my Thinkorswim? Let me delete this. All right, I'm gonna show you this. It's gonna take like fucking 2 minutes. So first, you start off. No, I'm not even gonna do Tesla. That's such a waste. Something that's decent. Oh snap! Looks like a 5-year-old has been drawing on my charts. Let's do. Give me a stock. Give me a decent stock that hasn't been running fucking $2,000 the past month, because it's not gonna be worth it showing a thing. CRM. Oh my gosh, not CRM. UPS. Let's get UPS. Nope. Netflix. All right, Netflix is decent. All right, look. You want to start off on the bottom down here. You want to go start at the top. So yeah, the top, bottom. It's like a sandwich. Move down the middle, right? You want to look for 3 different touches on the support and then the resistance, right? You want to look for 3 different wicks that touches, like this, that, 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 there, 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 there. That's the weekly. Daily, you move on to the daily, see if there's something there. If you don't see anything, then you don't have to make it. Four hours. Move on to the 4 hours. If you don't see anything on the 4 hours, you don't need to bother making it. That's good. Move on to the hourly. If you don't see anything on the hourly, you don't need to make it. Good, good, good. Now go to the 5-minute. You'll have your entries and exits for puts and calls. And you can like tweak it if you want. Got another one there. Boom. Like that. It's not that hard. Okay, now back to the slide. Okay. Stochastics oscillators is a lagging indicator. 90% of all indicators are lagging indicators, including stochastics. It is important to note that the stochastics is, oh my gosh. If you guys want to go on YouTube, look up Kevin Trades on YouTube, and I have a whole fucking video on support and resistance. I'm like explaining it really slow, so it's gonna be like the one with like, yeah. There's a lot of good videos up there. Honestly, I show all my strategies on all of them, and I don't see how people like honestly, dude. I'm like sometimes everything I'm like explaining to you guys are on YouTube that I posted, just so you know. Overbought, oversold levels often indicate a strong trend and not a reversal. There is a wrong belief that stochastics can point to overbought or oversold levels. A stochastic value of more than 80 might indicate a strong uptrend and then a reversal. So you have here this example, right? You have a critical resistance here, 1, 2, 3. You guys see this breakout, right? This breakout was followed by a what? A crossover. So this breakout was followed by a crossover, but before it even broke out, what happened here? Stochastics crossing, then the price breaks out, and then the EMA starts to cross right at the breakout, and the volume bar does what? Increases at the breakout level. That's when you execute on your trade. Stochastics plus range plus EMA strategy. So you have here, you have the stochastics on the left. What is this telling you? A shift in momentum. Boom, you have a shift in momentum, and then you have the EMA crossing over here. Now, why is this such a good entry for puts? Because the price has already fallen below the what? The resistance. The support. It's already fallen below the support. This is a big move. Just imagine this. Look at the right. Look at the right. Look at this. The distance from this support to the next resistance. How many is that in dollars? $7, right? Now, if you enter at this breakout right here, this whole move down here, that's like $20. That's more than enough for you to capture a move, right? And then what happened after it, starts to consolidate, kind of move up, and it creates a range, and then it does what again? What does it do again? Literally again. Same fucking setup. You have the move, you have the fucking shift in momentum, then you have the crossover, and your entry is below the same what level? And this time you catch a fucking $40 move down, $50 move down. Using EMA plus stochastic strategy for finding swing trades. This is an actual swing trade that we took. Shift in momentum down here, crossover up here. The reason why this is how you do this, right? This is how you do this. You have to wait for the price to be midday. You wait for the price to be midday because you don't want to enter a swing as soon as the market opens. That's like the stupidest thing you can do. You wait until you see the price midday. Why? Because you want to wait for it to do what? It starts with an S. 6 letters. Settle. You want it to settle above the resistance line. See how it's settling there? It's settling. It's establishing what? Starts with a B. Buyers. It's establishing buyers up here, right? Buyers are establishing themselves on the support line, and then you take that swing to the next day. Does that make sense to everyone? Cool. Using EMA plus stochastics breakout to find swings. Look at this. This is like such a golden fucking setup. This is another call out that we did. You have a rejection here. Obviously, you're not going to enter this breakout because what did it do right here? It didn't. It crossed down, right? It's like you're not going to fucking trade that breakout to the upside, right? Boom. And you have the next day. The next day, it rejects again. Rejects pre-market. Rejects, right? Boom. And then the third time, what didn't happen here and here but happened here and down here? Stochastics crossing first. What has to cross first? Stochastics crossing first, meaning, right, there's a shift in momentum. So the price was obviously going down and it shifted up, right? The momentum shifted from it bearish to bullish. You have the cross happening, and you don't necessarily want to enter before the breakout, right? You want to enter after it breaks out and establishes itself. Then that's when you swing it. A range. A range is a period of time where the price consolidates and creates a range where it neither can break above or below. The key here is to wait until there are enough buyers or sellers to push the price above and below the range. The target is measured vertically from the bottom of the lowest, fuck, that word is so hard to pronounce, tro. Who even came up with that word, tro? The lowest tro to the highest peak in the range. It is then projected from the point of breakout from the range. Trough. Man, whatever. This isn't English class. Bullish rectangle. Right? You want to look for the distance between the range, the top rate, from the top to the bottom. Right? Usually what'll happen is it'll move in accordance to how much the distance is between the top and the bottom. Right? You see on the right? This is how you like project how much it can move. Like, how you get one of those fucking moments where you're like, when should I sell? This is how you can kind of gauge and have an idea of like how much it can potentially move. And it's scarily, and it's literally like, it's so scary accurate. Range with EMA plus the stochastic strategy. This is when you use the stochastic. So look, you failed to break multiple times. Here, here, here. Then you have the stochastics moving up. Boom. You have the crossover happening. Boom. You have the breakout of the range up here. The breakout of the range, right? This looks like the previous example we just looked at, but it's actually different. It's actually different because it broke out of the range here instead of it breaking out of the range here. Now, it breaks out of the range. Boom. Stochastics moving up. There's increased volume. Look at this volume right here. Is this volume bar itself bigger than the previous fucking 4 days? You want to look for these volume spikes at the what level? Breakout level, resistance level, same thing. Range with EMA plus stochastic strategy on the 4 hour. You have obviously you have the range here, EMA crossing to the downside, the range breaks out to the downside. You had a shift telling you here that there's a potential shift here, and then it basically crossed over again down here, right? Because look, you can essentially say that this might have broken to the upside, but what did the EMA do instead? This is one of those ways how you can prevent yourself from entering a fake out. This is just one of those ways, right? In this case, you're swinging this. So in this case, right, you have the stochastics already telling you that the shift in momentum is here. So the momentum is to the downside, and it couldn't shift all the way up because there's literally the crossover, because literally it just gapped down, to be honest, pre-market. It gapped down here. You have the crossover happening during the day, and this is a swing that you could fucking take to the downside, right? You don't know. Obviously, you don't know. You don't know that it's going to go down this much. You don't know that, right? You might have probably took profits here, or maybe you took profits here, right? You use these support levels as your profit targets. I'm just showing you that this made such a big move. And obviously, I would not have caught this big ass move anyways. I would have probably sold here or maybe even here, right? But obviously, you're still going to take advantage of this trade. How do you gauge which contracts to buy? Anthony says, if you're going to swing, do you buy, if it's a Monday, is it fair to say you can buy Friday's expiration if you're gonna only hold for 1 day? Yes. If it's a Wednesday, if it's a fucking Wednesday, then it's like, dude, the theta's gonna eat my shit up. You want to go next week. It depends on how many days you're planning to hold, right? If you think that you're gonna be holding for a week because maybe because you're looking at a 4-hour chart, this breakout might take about a week, then go 3 weeks out, 2 weeks out. This is another way you can trade fake outs. Can you trade ETFs with these strategies? Yes. Stochastic showing a slowdown of bullish momentum up here, right? You see this breakout green level, right? You would think that it's going to break out to the upside, but since the stochastics is pointing down, right, you would already be able to tell that this is a potential fake out because the EMA stochastic did not cross up around the same time. 15-minute pre-market range plus stochastics and EMA. This is when it gets a little complicated, but you're gonna understand this soon. You have the little range. You guys see how it moves into a range here? See that? It's a range, and then you wait for the stochastics to cross up. Doesn't stochastic cross mean both uptrend and downtrend? No, a stochastic cross does not mean a both uptrend and down. It depends on where it crosses. It depends on where it crosses. If it crosses down here below the blue line, then it might be a downtrend. And you just wait. This is the thing. You wait for the EMAs to essentially cross after the stochastics crosses, so you know where the direction might be headed. Does that make sense? Okay. So you have the EMA cross plus bull flag, right? You see this bull flag right after what crosses? Bull flag here right after what crosses? 9-21. Before the 9-21 crossed, what crossed this? The stochastics indicating a shift in what? Because it was bearish right here, right? Went to support, indicating a shift in momentum, boom, to the upside. And then do you trade the breakout of the bull flag or the breakout of the pre-market high? You trade the breakout of the pre-market high because the bull flag and the pre-market high is way too close for you to trade the breakout of the fucking bull flag, in my opinion. Because you could have gone faked out here too. You never know, right? Because it's way too close. Because what if this area is so heavily, it's so heavy with sellers, right? If there's a pattern that shows up and you have the stochastics and the EMAs crossing together, but the breakout of the pattern is too close to the next resistance, just wait for the resistance to break, okay? Let me go to the next slide. I'll just do the next slide. Whatever. I'm giving you guys too much sauce, to be honest. Bum, 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 bum. All right. I better get some good Yelp reviews. Usually you can literally keep your support and resistance lines the same. I have resistance and support lines on Apple and Microsoft that are like literally the same level as fucking last year, right? All right, let me stretch real quick, guys. My back is hurting. Trends help you to have a clear definition in your mind so you can easily interpret when a trend is occurring. Uptrend. An uptrend can be described as a sequence of higher lows in conjunction with higher highs. Downtrend. A downtrend can be described as a sequence of lower highs in conjunction with lower lows. The easiest way to identify a trend is if you can draw a trend line. Trend lines are far more reliable and simple to use than moving averages. With an uptrend, the easiest way to trade is if you wait for the trend line to be hit and the price bar to continue to bounce upwards off it, continuing the trend. With a downtrend, the easiest way to trade is if you wait for the trend line to be hit and the price bar to bounce downwards off it, continuing the trend. A break of the trend line, particularly with rising volume, may signify the end of that trend. Right? You have downtrends, uptrends. Do you put, when you want to create a trend line on an uptrend, do you use the top of the trend? Do you use the top of the price or the bottom of the price? So with downtrends, you want to do the top. With uptrends, you want to do the bottom. If you do both, what do you have? Channel, good. Notice how price is contained in an uptrend by following the trend line nicely. This is a very good example of a trend line and how it reacts to the support. This is what an hourly trend line on the futures market looks like. If you draw a parallel line at the same angle of the uptrend or downtrend, you will have created a channel. Channel breakouts are usually very good, in my opinion. To create an up ascending channel, simply draw a parallel line at the same angle as an uptrend line and then move that line to position where it touches the most recent peak. This should be done at the same time you create the trend line. To create a down descending channel, simply draw a parallel line at the same angle as the downtrend line and then move that line to a position where it touches the most recent value. This should be done at the same time you create the trend line. When prices hit the lower trend line, this may be used as a buying area. When prices hit the upper trend line, this may be used as a selling area. Channel trading trend lines. Draw the bear trend line with the swing highs, and then you draw the trend line, parallel line with the swing low. So this right here, this candle right here, this could have been, signaled as a breakout to the downside, but obviously it's a little fake out that happened. But obviously, once you see that it breaks clearly out of the trend line, that's when you want to kind of enter the trade to the upside. Watch for reversal candles at channel bottoms. Bullish breakouts. Wait for a bullish bar to close above the upper Bollinger Band. This is the breakout bar right here, right? The bar immediately after the breakout bar must trigger the order. If not, cancel it. Bearish breakout. Wait for a bearish bar to close below the lower Bollinger Band. This is the breakout bar. The bar immediately after the breakout bar must trigger the order. If not, cancel it. You're gonna get little fake outs here, right? If you don't wait for the trigger, you can essentially, right, get little fake outs here and there. It happens as long as you minimize your losses. Flags and pennants. Flags and pennants are short-term continuation patterns that mark a small consolidation before the previous move resumes. These patterns are usually preceded by a sharp advance or decline with heavy volume and mark a midpoint of the move. Fierce moves, to be considered a continuation pattern, there should be evidence of a prior trend. Flags and pennants require evidence of a sharp, fierce advance or decline on heavy volume. These moves usually occur on heavy volume and can contain gaps. This move usually represents the first leg of a significant advance or decline, and the flag/pennant is merely a pause. Now, you see the pole, the size of the pole? You start the size of the pole from the last resistance level. That's the size of the pole. The size of the pole is usually the size of the breakout. Does that make sense? These are the patterns that almost always show up. Has anyone ever come across these patterns? They happen all the time, right? Triangle continuation pattern. Buy when the price closes above the triangle's resistance line. Sell when the price closes below the triangle support line. Flagpoles. The flagpole is the distance from the first resistance, right? The first resistance or support break to the high or low of the flag / pennant. The sharp advance or decline that forms the flagpole should break a trend line or resistance support level. A line extending up from this break to the high of the flag pennant forms the flagpole. Flagpole, that's how it's going to look for the bull flag. Flags. A flag is a small rectangle pattern that slopes against the previous trend. If the previous move was up, then the flag would slope down. If the move was down, then the flag would slope up. The price action just needs to be contained within two parallel trend lines. Now you have a bull flag here. Your entry can be A or your entry can be B. Okay, where is your stop loss? For example, it can be C if you want, but where there's another area where I prefer having the stop loss in this equation. Can anyone guess where my stop loss can be? Middle. Good job, Knight. My stop loss would be the middle. Why? Because if I'm trading the breakout and it goes all the way back down here, it's like, fuck, it's back in the flag. Because if you make your stop loss C, what can happen? Someone tell me what can happen if you make this your stop loss C? No, not just a loss, but what else can happen? This move down can fucking move so fast on you to the point where you can't even get filled selling your order. Does that make sense? Point A, to be clear, do you enter only after the candle closes above? You don't have to wait for it to close above it. You can just enter the breakout. It's up to you, because at the end of the day, you're risking your money, right? At the end of the day, if you trade the breakout here where B is, and you enter where B is, you're gonna catch all the momentum that you would not catch if you were entering at A. Make sense, Caval? Great. Point A is at the level of the top of the flag. As such, it is the most conservative entry point because it is where the stock is making new highs. You must make sure that the volume is increasing as the new high is made. Increasing volume means that there is conviction behind the move, which makes it more likely to be sustainable. Point B is where the stock breaks out of the flag itself. This is more aggressive than point A, and again requires increasing trading volume to demonstrate conviction in the move. Obviously, what if you see a stochastic cross and the EMA cross right after the bull flag? Boom, just enter it, right? If the entry is activated, then we need a stop loss. Point C is the level where if we're already in the trade, we exit with a small loss. Obviously, you're going to exit with an even smaller loss if you make it in the middle. Same thing to the downside, right? I don't need to read this to you guys. Like, I don't want to just, this is like me wasting time reading this. It's the same thing for the downside, literally, right? Enter at B, your stop loss should be in the middle, or you can make your stop loss here if you want to. It's up to you. Whatever works for you, right? Flags. Now, this is where risk to reward and probability plays out, right? Now, you have the flagpole here. You see the distance of the flagpole is the same as the breakout, right? So if you make your stop loss in the middle, right, that's how much you're risking. And the size of the pole is how much the reward can be, right? So this essentially can be a 1-to-4 or a 1-to-5 ratio. Does that make sense? What does the 1-to-4 or 1-to-5 ratio mean? You're risking 1 to make what? 4 to 5, right? So in this case, if you were to calculate risk based on movement, right, you're risking a $7 move to the downside to get a what move to the upside? A $39 move. Wedges. Wedges are very common. They tend to represent trend channels with a slight upward, downward bias. Wedges are the same as trend channels, except the lines are not parallel. They are slightly slanted, which means pinch outs occur. Rising wedges give rise two upward breakouts more often than you think. Wedges can be bearish or bullish, so always wait for confirmation. Bearish rising wedge. As you can see, the price came from a downward trend before consolidating and reaching higher and higher highs, even higher lows. Okay. Now, in this example, right, is this a good candle to enter off of? Is this candle a good candle to enter off of? Falling wedge. Just like the rising wedge, the falling wedge can either be a reversal signal or a continuation signal. As a reversal signal, it is formed at a bottom of a downtrend, indicating that an uptrend would come next. As a continuation signal, it is formed during an uptrend, implying that the upward price action would resume. Unlike the rising wedge, the falling wedge is a bullish chart pattern. In this example, the falling wedge serves as a reversal signal, right? The distance between the top of the pattern and the bottom of the pattern is what it can potentially break out of instead of in terms of movement. Notice how the falling trend line connecting the highs is steeper than the trend line connecting the lows. Triangles, my favorite, one of my favorites. A symmetrical triangle is a chart formation where the slope of the price's highs and the slope of the price's lows converge together to a point where it looks like a triangle. That, right? Simple. What's happening during this formation is that the market is making lower highs and higher lows. This means that neither the buyers nor the sellers are pushing the price far enough to make a clear trend. Triangles continued. You see the crossover happening right before the breakout, right? Obviously, the volume would probably support this breakout, and that's when you enter. Bullish cross hinted of a breakout to the upside. Watch for these types of gap fills that may happen on your chart. I'm looking at a 4-hour time frame on Apple, right? Sometimes these gaps will happen and it won't even fill for another few months. But if you're looking at a potential gap fill, just take that trade because usually they will fill the gap. EMA cross plus pattern plus stochastics. What pattern is this? What happened before it broke out of the wedge? What's the first thing that happened? Number one, stochastics crossing over from bearish, right? Bearish to bullish. And then you have the EMA crossing over. And then you have the breakout here. Look how much it moved up. 4-hour patterns plus stochastics crossing. If you were able to identify these patterns, wouldn't it be easier for you to trade breakouts? Because you see them so often. Now, my tip to you when you're looking for patterns is just like take the time out of your day to just, mess around with charts like for an hour or two, right? Like I'm sure everyone here has an extra hour time of their day to just, get familiar with how the charts are because you want to get used to seeing these, right? You're not going to be able to identify them immediately, but the more you look at charts, the more you can see these patterns more clearly. So in this case, you have the pattern here, right? You have the pattern here, you have the breakout supported by the stochastics because then you see that the price is obviously moving down and you have the shift in momentum happening. And then you have an increase in volume on the second candle, right? That's a swing trade. It's a 4-hour chart. Symmetrical, just look at this. 3 fucking days in a row. After the second day, can't you kind of see like, oh my gosh, I should just enter this trade? Does that make sense, guys? This is an hourly chart. After you see this triangle breakout here at the open, right? This is still, the first hour, the second hour, right here, right? This is like 2 hours right here that you can capture it. Ascending triangle plus volume plus stochastic crossing. So you have an ascending triangle here. You have the breakout of the ascending triangle and you have increased volume at a resistance. What crossed first here? Again, this is without the EMAs. What crossed first? Stochastics crossing first, and then you have a spike in what? Volume. You have a spike in volume, and it's considerably fucking bigger than the past how many days? 1, 2, 3, 4, 5, 6, 7. 7 days. Bigger than the past 7 days. Right? The whole week. Why did the volume spike so much compared to the whole week? Because it wants to break out of this little pattern. Right? It wants to be a big boy and break out. Now, would you enter this trade right at the breakout, or would you enter this trade after the breakout of the resistance? This is a long-term resistance, by the way. You wanna make it so that it breaks out after the resistance level, because it's too close. It's way too close to be trading this breakout, because even though there's a lot of volume and stuff, it can always reject itself. Because look, you see this little wick right here? What does that mean? What is this little wick right here means at the top of this candle? There was selling pressure over here. Remember that. There was people trying to sell it right here because this resistance level was so strong. Okay? How accurate is TOS with identifying these patterns with the pattern setting? Honestly, just do it yourself. It takes 2 seconds to create a pattern. It takes all you got to do is just stretch the line down and stretch the line down. Literally takes 2 seconds. You guys, don't be lazy when it comes to this. Like some people, people are always trying to find the easy way out. If you take the time to study it, you can do it, right? Ascending triangle plus bullish pendant plus stochastic cross. You have the ascending triangle here breaking out, right? Do you see the distance from here to here and from here to here? It's generally the same, right? The distance from this support to the top of the fucking pattern and the breakout of the pattern to the next resistance up here. Is this the same distance? It is, right? Symmetrical triangle, 5 minutes, plus stochastic cross at the breakout. Now, here, this is where it gets kind of tricky sometimes. You have a triangle forming here, but it's really close to the next resistance. Do you really want to trade this breakout for a day trade, or can you scalp this, for example? Scalp. The difference between scalping and day trading is your position size, right? You don't really scalp with one contract. Does that make sense? You don't really, scalping is not you entering with one single contract. Scalping is you buying 5, 6. Because the point of scalping is to try to capture small increments and still get a decent result. Does that make sense, guys? Like scalping with one contract is literally like, it's so pointless, right? If you want to trade one contract, you wait for the actual breakout of the what? The triangle, right? In this case, it happened here. You said gaps must fill. Do you see gaps on all time frames, 1 minute, 15? No, you only want to look for gaps on like the daily or the 4 hours. I feel like don't even get into scalping before you start learning how to day trade. Like if you can't manage a $500 contract, what makes you think you can manage a fucking $5,000 contract? I'm not talking about the cost of the contract. I'm talking about how many contracts you're actually trading. You know what I mean? If you go from fucking not even trading and then now you want to go buy 10 contracts, you don't even know how to manage 10 contracts. Right? You have to get, you have to start from the basics first, in my opinion. For a beginner, I suggest you start day trading first. Just there's the money that you invest into yourself when you're day trading, right? You're gonna lose money. Let me tell you that. Right? I'm gonna tell you straight up. Like a lot of people fucking think that. Like people will tell you, oh, you're gonna start making money after you learn from me. No, you're gonna fucking lose money. Let me tell you that. Why? because you have to figure out your trading style first. You have to figure out how you're going to trade. My trading style is different than Eddie's. It's different than GK's. It's different than Kai's. It's different than Alex's. It's different than Anthony's. It's different than Alwan's. It's different. It's different from Eddie's. My trading style is different. You have to develop your own trading style. And how you develop that is by trading. You just keep on trading and then you get used to it, right? Pattern analysis for swing trades. You see how on the left here, you see the resistance level over here? You see that, right? So you have a resistance level here, and then you have it falling to a support here, right? You make that, and then it goes into a range. Now, when it breaks out of this range that I'm looking at, where is my next profit target? When it breaks out of the range here, where is my next profit target? The last time it hit the resistance, right? The last time, right there, right? Then it goes into another range, and then it breaks out of this range. Where is my next profit target? The last support line, right? You see how it's pretty self-explanatory when you look at it this way. Then you can start identifying. You need to learn how to do this right here, what I'm doing right there. Every single time it formed the pattern, I made the line. It's not like I fucking made the line after I saw this move. No, I made it as it went. I was trading every single fucking pattern I saw. Bear flag, little breakout, little fucking, it took like a whole day. Boom, another breakout of the bear flag. A triangle, break out of the triangle. Break out of this, break out of this, break out of this. You guys see that if you can start identifying patterns, you can trade the breakouts easier, right? Start familiarizing yourself with these patterns and start looking at them on your charts. Obviously, you're not going to just trade the fucking pattern by itself. You have, what indicators did I teach you? Do I teach you guys? Exactly. You can use those with the patterns itself. You don't want to just trade the pattern by itself. You don't want to trade the stochastics by itself. You don't want to trade the EMAs by itself. You want to incorporate all of this into one strategy. Now, let me tell you this. Just because I'm showing you my strategies doesn't mean that you should use my strategies. I'm just showing you that if you combine multiple indicators to create one strategy, it'll work out better for you. Does that make sense? Like, you don't have to use the stochastics if you don't want to. You can find something else that works better for you. There's so many strategies out there. This is the one that works for me, and I'm showing you what works for me. It might work for you, it might not, but just know that it works for me, right? And I'm sure a lot of people here who are in the group, it works for them too. And yes, I do use the TTM squeeze. We're not going to go over that today. We'll go over that next week. Now, as a last example, how many patterns do you see here? Take like 2 minutes. I want at least 20 people to answer this question. So just take your time. You can use it on the 1 minute for scalping if you want to. It depends. You can use it on any time frame. It's just a little more whacked out when you're using it on 1 minute because it moves so fast. It's not as smooth. It's not as smooth as looking at it from a 5 to 15 minute perspective. All right, you guys got the answer? Seven. If you got 7, you're right. You have, what pattern is this one right here? What kind of flag? Okay. What is this one? Another flag. What is this one? This one. I bet you guys missed this fucking range too. I'm telling you, I bet you missed this. Don't lie. You guys be lying. A lot of people miss this range, okay? You guys be lying, knowing damn well you missed it. This and this, right? When you can identify these types of patterns, you're gonna be this like being able to identify this is your own. That's like an edge in itself because you're taking the time to actually make these patterns. You know what I mean? Some people don't even like to take the time to just look for them. But when you have them, when you understand them, it's easier to trade breakouts because you already see the pattern. Okay. So next week we're gonna go over TTM squeezes. We're gonna go over psychology. We're gonna go a little more about patterns and how they work. Yeah. Hope you guys enjoyed class today. Any homework? Oh yeah, let me give you guys want homework. You guys want homework? Let me give you guys some homework. All right. Let me see. Okay, my homework to you guys is now write this down. All right. I want you to look at Facebook, Amazon, Apple. Are you guys writing this down? AMD, Costco, Home Depot, Walmart, and EA. Now look at these stocks. I want you to do this. So first, I want you to see if there's any news revolved around the stock recently. Okay? Look for any news revolved around the stocks as recent as this week. Like, don't go anything past this week. Just this week. Now, you want to do what I did. Find the resistance and support on the weekly, move on to the daily, move on to the 4 hour, then the 1 hour, and stop there. Because by then you should already have your levels. Now, I want you to make your own levels of entry and where you would exit. If you're looking at a stock that's already at its own high and there is no next resistance, how many in terms of dollar increments should you go for your next profit target? There you go. ATR. All right, real quick, I'm gonna show you guys how to set up the you guys want me to show you guys how to set up the 9 to 21 EMA? Anybody? All right. So look, you guys can see my screen now? Hold on, I can't see the chat, so I can't see. Now go right here, go to studies. You see where it says studies? Edit studies. Once you go to edit studies, it's gonna show you this. Once it shows you this, you wanna go here. You wanna search it up. MOVAVG-EXP. Oh, go on strategy. Yeah, right there. MOVAVG-EXP. Click it. You see how it shows up there? Click it twice. Okay, once you click it twice, you go to the settings button. Once you go to the settings button, it's gonna show you this. Once it shows you this, click on the length, pick 9, and then click the other one, pick 21, and change the color. It doesn't matter what kind of color you choose. You can make it fucking pink and black. I don't care. You can make it white. You can make it, just don't make both the same color because then you wouldn't know what's crossing. You'd be like, oh my gosh, they're both crossing, but you wouldn't know what's crossing. Now, stochastic slow. Stochastic slow, same thing. On the stochastic slow, you want to do this. Look up STOCHASTIC. Go on the very bottom. Stochastic slow. You leave the settings that's on there. Stochastic slow. You leave this. You leave the settings that's on there. Leave the default setting. All right. All right, guys. Can you guys please go to the Discord and kind of I'm gonna make before. Just don't leave yet. Don't leave it. I know you guys are eager to leave, just like yesterday. It's Sunday. You guys are probably still turning up today. All right, please write, how today was. Like if you learned, what you learned today or how today was. Just don't I don't like when people say like one word like fire, cool, good, great. Like, dude, okay, I get it. Cool, but why? Right? Currently not able to use Robinhood. What other platforms do you recommend? TOS. This is why you're saying if it's user friendly, use TOS. Okay. All right, guys. You guys have a good rest of your day. Please tell me how today was.